Good day, everybody. My name's Emmett, Kilduff. I'm the CEO of the Fortia Group. Welcome to this month's webinar, which is all about valuations, and thank you for taking time out to sit in on the webinar, particularly given such a quiet time of year. Before I kick off, I'd just like to say a big thanks to our lead sponsor, Clearco. Clearco is the title sponsor of our monthly webinar series, and it has financed over 7,000 founders around the world over the last few years, giving them 3.5 billion of capital. So a serious player in the revenue-based financing space. For the aggregators on the call today, it's also increasingly helping aggregators and other buyers find distressed brands. It's got access to an incredible amount of data. And so for those that are interested in that, please either reach out to Clearco or ping me and I can introduce you to our head of our primary contact. For any other firms that are interested in sponsoring our webinar series, please do reach out. We want to increase the number of sponsors as we go through the next few months. So without further ado, let's jump in. Brief advertorial. The Fortia Group, for those that don't know us, we're exclusively focused on M&A in the e-commerce space, the full spectrum of e-commerce. So that could be FBA brands, DTC Shopify brands, or indeed we're currently live with an Amazon SaaS tool for sellers. So the full spectrum. The three solutions we provide to e-commerce entrepreneurs, number one is a value estimate. The topic of this webinar today is all about valuations. Hopefully you'll see there's a lot of good content, both from our esteemed speakers and ourselves, and we'll be delighted to follow up with anyone that wanted to explore the value of their particular brand. We have 10 clients in our Exit Ready program. They're clients that are not ready to sell today. They might want to exit in 2023, 2024, and we help them become buyer ready, which ultimately helps them maximize their payday. And of course, we sell businesses all the time. That's our bread and butter. And we currently have 12 clients that are either live or about to go live to the market. All of the webinars we do since October last year are demand-led. So we don't just come up with the topics. We ask you, the audience, what you want us to discuss. So what I'm going to do now in a moment is run a quick poll and get your feedback on what topics you'd like us to cover in September through to December 2022. So the topics that we'd like to propose you to vote on, starting on the top left, is the due diligence process. What should a seller expect during the DD process, whether that's a DD process of an aggregator, a private equity firm, or a corporate? Going down top to bottom, how to become exit ready. In our view, failure to prepare to fail. It's really important that entrepreneurs think about an exit as early as possible. That will help maximize their payday. So we could discuss all the different steps one could do to become as ready, buyer ready as possible. Survey of FBA and DTC aggregators. We did a survey of FBA aggregators in October last year. The recording on YouTube has over 2,000 views. So we could run that survey again and also include DTC aggregators and maybe also private equity, which could be interesting. So going across the bottom, then other suggestion. If you do have a suggestion for us that we haven't submitted today on this slide, please reach out, ping exits@thefortiagroup.com and give us your suggestion, and we'll put that into our thinking. Outlook for 2023. In December last year, we did a similar webinar. We're proposing it could be interesting again this December to look ahead to next year, talk about market conditions. Is it a good time to sell? What people should be doing? Stories of successful sellers. I think it was February this year, we had one of my favorite webinars to date, 10 sellers who had sold their businesses, having fireside chats with me about the lessons learned, and we'll touch on a few of those later on today. And then finally, how PE firms value brands. So a lot of our content is all about aggregators. We work with other types of buyers like private equity and corporates, and we propose that it might be interesting to understand in detail how PE firms value brands. So there are the options. So I'm going to start the poll now. Hopefully that's all coming through, and I'll just give you all a minute to complete that. Thank you. Excellent. Thank you. So I will end the poll and I will share the results. So high up is survey of FBA DTC aggregators, 26%, followed by how PE firms value brands. So we will take that into our consideration. Again, if you have other suggestions, please email us direct. Thank you. Okay, so let's talk about today's webinar. So back in June, we surveyed the audience for their preferred topics, and valuations, no surprise, was a key topic chosen. Other topics were acquisition criteria in a bear market, which was our July webinar. And for those that haven't seen it, the June webinar was 10 CEOs talking about the future of the aggregation space. All of the webinars are available on our YouTube channel. So today's agenda, 3 points. One is we've asked the speakers to give TED type talks. We have 2 DTC aggregators to start. Then we have an individual, TJ, who advises PE firms and came from a strategic. And then we'll go to 2 FBA aggregators. So hopefully that gives a good balanced view of buyers. We will then give our own views on valuations and interesting data points about market conditions. And then we will have time to discuss the valuation ranges in a bit more detail and answer your questions. From a housekeeping perspective, please submit your questions via the Q&A button on Zoom. Please do not submit them via the chat or they won't be answered. And as a reminder, the deck and the recording will be made available to all participants in the coming days. Okay, so without further ado, let's start the talks by the thought leaders. So first up, we have Eric Sattler, who's president of Win Brands Group. Eric, are you there?
I am here.
Great, over to you.
Well, thank you. Appreciate being here. You can go to the next slide. Just really quickly on Win, because I think this gives you perspective in terms of how we think about valuation and how we think the market's been changing. Our business has been about really creating a house of brands, and we've been doing it in a very methodical way. So if you look at this timeline here, we've bought about 1 business per year, which I know is very different than probably some of my counterparts on this call on the Amazon side. But we bought Homesick in 2018, Kalo in 2020, Gravity in 2021, and Love Your Melon in 2022. Collectively, they cover 3 segments: home, sport, outdoor, and wellness. And very interestingly, we bought our first bolt-on acquisition, MyHigh, which was Gravity acquired back in May of this year. And the reason I highlight this is, for us, we really focus on larger size assets with a really strong brand and community. So if you go to the next slide, kind of gets into the criteria of how we think about things, which is at a very qualitative level. We look for brilliant founders, great management teams, because they often do join us on the other side of these transactions. Strategic fit, which in some cases is what category they're in, but generally that they're category leading. And then lastly, there's an emotional connection with the customers. And that's usually something, one signal there is repeat rates on purchases. Again, these businesses tend to be direct first, in our case, 60% direct, but very quickly we extended them into the Amazon and the wholesale channel. So that's kind of the qualitative view of how we look at things. If you go to the next slide, we can kind of get into some of the quantitative. Now, I won't go through every line on this slide, but I will kind of highlight how we think about valuation and how we think about assessing these businesses. Effectively, there are 5 buckets of analysis we're doing: revenue channel expansion, gross margin expansion, marketing efficiency, operating expense, and financial leverage. Those are the things that we're looking to see. Can we make improvements on the other side? The metrics on the far right are examples of target metrics I would consider you're in a very strong position. So for example, gross margins of 60 to 70%, that's great, that's amazing. We'll look at businesses where there's 50% gross margin. If we see a business that has 40%, even if we were to resource it, there's probably something fundamentally wrong in that business, whether it be a pricing issue, a discounting issue, or sourcing issue. It's going to be harder for us to get there. So this gives you a framework of what you want to see your target metrics at that would point to the higher side of our valuation. If you start to see marketing costs of 30-40%, one, I'm going to assume there's something wrong in the business, but two, it is also telling you that you're going to look at a lower valuation from our standpoint because there are issues in marketing efficiency. The one danger about looking at these metrics is the opposite can be true. So for example, let's look at customer repeat rate. If we see 50+% customer repeat rate, you might say, oh, it's amazing, our community is super engaged. But actually it could mean the opposite, meaning your acquisition funnel has dried up and you're retargeting to your existing customers, and this business may be on a downward spiral. So those are some of the signals we tend to look at as we think about where does this sit in our valuation range. If we go to the next slide, we can talk about how do we think about valuation. And, really, this is, kind of sounds like investment banking 101, but there are three components that make up a valuation multiple: the size of a business, the growth rate, and its ultimate margin. And if I look at the current state of the market, in general, what we see in the branded businesses we're looking at is the mid-market. If you're a business sub 50 million, it's very hard to trade on a full acquisition. You might find a growth investor or someone to come in. We can go into what that means in a few minutes. But generally, it's hard to exit when you're subscale, sub 50 million. At the same time, depending on what category you're in, it also can be hard to trade. So in the home category, for example, businesses that are less than 100 million often aren't very interesting to the strategic buyers because that universe is a lot smaller. From Wynn's perspective, we're kind of playing in that mid-market below. And we look at businesses, as I mentioned before, 5 to 50 million. We'll look at stuff at 20 million or larger, or we'll look at smaller things that are bolt-on. So great example, that MyHigh acquisition fit in the bolt-on category, and we're able to add that to an existing platform, in this case, wellness. So from our perspective, we're a little bit more flexible as we look at these things, and that makes us a unique strategic buyer relative to maybe other traditional PE, et cetera. When you look at growth rate, and this is probably the thing that most brands are struggling with right now, especially in the D2C and even Amazon world, given the Facebook iOS changes last year, historical growth equity, PE, they want to see 50+% growth rates. When we target our businesses at 20%, we're fine seeing a business growing 5 to 10%. That's okay, because we're focused on long term. We're not trying to buy a business and sell it in 3 or 4 years. And what we're really trying to think of is what's the next decade or two to look like for this brand. And that's really important in terms of our lens, but also changes the framing of what we look for when founders are trying to exit. On the margin side, profits are always important. And this is becoming increasingly more so now, where you're seeing a focus on EBITDA multiples versus revenue multiples. Traditional PE, they're going to see 10 to 20%. Growth may look at 5%. But if you don't have profits, from Wynn's perspective, we can't even value you, because we look at things on an LTM EBITDA basis, because we want to see if the business works on its own. And then we can talk about all those points of improvement that I looked at the last slide, margin expansion, et cetera. So we'll look at things a little bit smaller, where our goal is to bring them higher, but we want to see profits. And the more profits you have with growth, with sizing, means you're going to be on the higher end of any buyer's multiple range going forward. You can go to the next slide. So some observations when we look at the market in terms of quality, pricing, and structure. So what is happening right now in terms of quality of assets we're seeing? I will tell you that we're seeing bigger assets trade in a range that we want, but we're also seeing a lot of lower quality assets hit the market. And what I mean by that is, during the diligence process, and this is a very frustrating thing for founders, the investors are always asking for updates on financials, because what they're trying to do is track how are you doing against your forecast. So I shouldn't say this because Emmett's on the phone, but you want to put your advisors always say want to put out the best growth plan going forward. But the reality is, if you aren't meeting those forecasts, you're losing confidence from the investor. So what I'm put here is I can think of in the last 4 out of 5 deals, we basically saw brands underperforming, and that really caused a problem in the process. From a pricing perspective, we used to see 8 to 12 times is what bankers would be pitching us. In the last 6 to 8 months, I'm seeing bankers and even founders kind of move towards that 3 to 6 LTM side. And then the last thing is structure, which is you still can get a high valuation. That 10 to 12x could happen. However, it comes with structure. And 2 out of 3 opportunities that we followed up on that we passed, the structures were very punitive, high liquidation preferences, junior stack of equity. So you got to really be careful. Last slide. So what should you do knowing these things? You can skip the next one. 3 things I would think about in terms of optimizing your multiple. 1, focus on margin expansion over revenue growth. I know it sounds counterintuitive, but if the traffic's not there, the traffic's not there. I'm seeing a lot of businesses that are growing growth-wise, but their EBITDA is getting worse, and that actually tells me the business is that's a real problem for future growth prospects. 2, to my earlier point, beat your forecast. Put in manageable forecasts that you can actually do. And 3, stay patient if you do want to get back to growth, because you do need 2 solid years for us to say, okay, this business looks like it's in a healthy place and you can go forward. So don't try to force anything. Be patient and optimize your business. I think that's it.
Excellent, Eric. Thank you very much. Lots of good points there. And we will get into discussion and Q&A after each of the speakers has had the chance to air their thoughts. So thank you very much, Eric. Great start to the webinar. Over to you now, Ken, please.
Hey guys, can you hear me all right?
We can, yeah.
Awesome. Well, thank you so much for having me. I'm honored to be part of this webinar. My name is Kenneth Ott. I'm the co-founder of Metacake, and Metacake is an e-commerce growth team. And we've been able to help some of the most well-known brands in the world grow in what we call healthy ways over the last 10 years. And these are the brands like Old Spice, Tony Robbins, Groove Life, which is Eric, I know Kalo very well, Jenny's, etc. And we say, I only say that to say, our goal is to help grow brands that matter. That's our mission. And that's not just a nice thing, but that is, when we get into valuation, how we see growing the valuation of a company. Building a brand that matters to a customer is one big piece of that. We have 3 areas of business: consulting, training, and then a capital arm. And so I'm actually the principal of Doe.Capital, which is our e-commerce focused investment firm, and we go and acquire direct consumer businesses that are typically founder led, and we help grow them to the next level. And so I mention those things to say, when we look at growing the value of a company, it's through the lens of direct consumer, not marketplace led. And I'm going to share with you the way that we look at valuation, the way that we look at increasing valuation. So we can jump to the next slide here, Emmett, please. And so in our view, in our experience, there are like only 3 parts to growing the valuation of any company or a direct consumer company. It's really maximizing revenue while reducing costs, and doing that with increasing consistency so that those 2 things happen at an increasing rate into the future. It's really kind of breaks down into those 3 areas. And if you can do those and really do them at the same time, that's how you increase your valuation, or at least in my experience, how we increase the value of a company. And so let's jump into each one. I'll sort of give you, in my experience, some of the best ways to increase, to improve each one of those areas. So we can jump to the next slide here. And the first one is growing revenue. And so there are really only 3 ways that you can grow revenue. You can increase prices, and that's not average order value. Those are prices, what you charge for your products. The second is you can increase the number of new customers, right? How many people come through and purchase. And then the third is you can increase your lifetime value of your customers, which is how many times, obviously, customers purchase from you again and again and again. And so one of the best ways to increase prices, in my experience, is building a real brand. And a brand is not just, logo and that kind of stuff. A brand is how the customer feels when they interact with you. It's why, it's the trust that you have and all those kind of things. And I give a little example, ironically enough, Eric, Groove Life, which is us and Kalo have been back and forth a few times over the years. It's Groove Life is a silicon ring company. Well, they started as that, and I helped found that company. And at the beginning, we couldn't charge much for our product, and there were a lot of competitors. As we elevated our brand and we did certain things intentionally to do that, we're able to charge $55 for, a silicone ring. It's one of the best silicone rings out there, high quality, etc. When at the same time on Amazon, you can get those rings for, $5-6. Now they're not the same rings, they're lower quality rings, but from the customer perspective, the way that you increase prices, in my experience, is by building a really rich brand that allows you to build trust with the customer and build value into the customer's life that allows you to increase your prices. Brand building actually probably spans all three of these things. And so if you want to get more customers in, obviously your brand is a big part of that, but increasing your conversion rate, specifically in your e-commerce store, is a big part of that. It's the tide that rises all ships. It increases the effectiveness of marketing, and effectiveness of lifetime value. And so that is the best way that you can bring more customers in and improve everything. Then lastly on this one, increasing your lifetime value. One of the best ways to do that is through some sort of continuity strategy. And that might be, you have a consumable product, that might be a subscription, that might be a membership, or a lot of times I see companies trying to bolt on those things. And you don't necessarily have to. You might just have to have a really good ecosystem of products, right? That people can come into your world, that you can resell to them over time and enrich their life in the solution that you provide. And so that is in revenue growth. Let's jump to the next slide, in reducing costs. And so reducing costs, like typically for a direct consumer company, the biggest expenses are marketing budget, or aside from HR, are marketing budget, inventory costs, and then shipping costs. And so when you get to marketing, one of the best ways to reduce your marketing ad spend or your marketing budget would be focusing on owned channels. And I won't get into owned versus unowned, but when you're marketing on PPC like Facebook, like that's unowned, they own that land. Email marketing is one of the things that we focus a lot on with our brands, because it is one of the highest revenue, like ROI. According to HubSpot, it's 36x, compared to something like Facebook ads, which might be 4-2x. And that's kind of what we see as well. And so we focus on owned channels there. And if you focus on that, I think you'll be able to improve your cost reduction. The second one is inventory costs. And so when we look at brands, especially to acquire, there's a very specific margin that we're looking for. And so we're looking for a minimum of 5x gross margin. And really, we're looking for 30x plus even when it comes to products. And that margin is what you can invest into brand building, innovation, R&D, like all of these things that are really important to the health of the business that comes from that margin. And so when you look at cost reduction, look at high margin products, like focus in that area. And it's not cheap products, it's still high quality, but high margin. That's where you build value in. And the last one is shipping costs. Focus on lightweight, easy to ship items. That's kind of what we look at. We don't want breakable and expensive and heavy ones. Let's jump to the last slide here. And so increasing consistency. This is one that, this is like future focused, right? This is where probably most venture capital comes from, is like looking at the future. And this is this third part that we look at when we're looking at businesses or increasing value. The best way to increase consistency, in our opinion, is being a solution brand and not a product brand. And that's a very small nuance. And we see a lot of people, like we noticed that in COVID, like you start to become, when the pandemic hit, certain brands popped because they had certain products and they became known, and it kind of centered their company around those products, but not the solution that the product was solving. And so a lot of companies, that tended to be a fad in that period of time. We're looking for brands that are not fad brands, but are solution brands. And those products that they have may change over time, right? So I give a couple examples here, like Apple versus Xerox, right? Like, we all know the story of those guys. For us, there was a ring company called Safe Rings, which just did functional rings. That's what they were known for. With Groove Life, we set out to create a brand that was a lifestyle brand around adventure and products that kind of helped customers do that and live an adventurous lifestyle. And so that's a big part of increasing consistency. The other two things are build for tomorrow, like you're running two businesses, today's business and tomorrow's business. So look forward to tomorrow's business. And then the last one is diversifying your marketing and sales channels. So many brands have almost all of their sales coming through Amazon or one other channel, or all their marketing coming through Facebook or another channel. That is ripe for disruption. We've seen accounts get shut down, all those kind of things. And when we're looking at stability, and especially from an acquisition standpoint, we're looking at reducing that risk. And so you want 80%. If you have an 80% or more sales or marketing channel, in my opinion, you need to diversify those. And so I know that was fast, but hopefully that was helpful. Happy to answer any questions in the chat as well.
Great. Thank you, Ken. So yeah, if you do have questions for Ken, please submit it via Q&A. Eric has already responded to a question in the last few minutes. Great. So they were the views of two DTC aggregators. Now, before we get into the two FBA aggregators, we have TJ, who worked for Coty, so worked for Strategic, and is now an advisor to private equity. So TJ, welcome. Over to you, please.
Thank you so much, Emmett. Good afternoon, everyone. It is a pleasure to speak to you today. I am coming to today thinking of what I call creative industries, creative economies, that being my background in beauty and fashion, largely in private equity. So I wanted to look at today under two lenses. First of all, what makes those industries different? And second of all, having been in a strategic and also in a private equity seat, what is it that makes those headline valuations stand up? In other words, why are they worth it? Next slide, Emmett. That's my cheeky play on my competitors, L'Oreal's headline, because they're worth it. In the creative industries that I've found, I think the real distinction is what I always call the cult of personality. You have founders who have their names over the doors. You have creatives who are makeup professionals. You have fashion designers, et cetera. And that name really means something to them. And I can't come in here, having worked for Coty for so long, without addressing the elephant in the room. Every single time I do a speech, I get asked about the Kardashians. I cannot tell you what they're like to work about. There are some confidentiality concerns, but I will address Kylie Jenner. I actually didn't work on that deal because I was general counsel of a division at the time, but it provides a really interesting lens, I think, for some of these questions here, particularly the speed of evolution in the beauty and fashion industry. Largely a result of their own success. They evolve, they create new products at such a speed that they largely can't keep up. The shift from Instagram to TikTok is really an interesting one. And Kylie actually has been accused of not keeping up with the shift to TikTok. Now, this isn't meaning posting on TikTok. It actually means the products that you develop and how you put them on. So the lip kits are what made Kylie famous. But allegedly, I haven't tested this out, but apparently this is not really what plays when you're posting on TikTok. And second of all, in this industry, there's been a historic question of the evolution of from bricks to clicks, and partly back now. When executives are looking at brand staying power, they really can't avoid looking at the question of, because this brand has physical stores, does it mean it will stay around longer? Is it just a pop? By the way, when we were at Coty, we looked at Amazon as another wholesale account. And Emmett, I think you will address some of those later in your speech. But those kind of digital markets, be it Walmart online, Amazon online, were another wholesale account for us. So for the other lens, I often throughout my career had investment bankers come along, and these are probably the bad ones, but they would agree a valuation, agree a price, and walk away. And then it would kind of be my job, first as a lawyer, and then on the business team. And so I wanted to answer the question. I think it might be helpful insight for you. What did I do to justify that that price is worth it, or determine that price wasn't worth it? And every CEO that I worked for always came at this first at a question of, is the brand new? Is it novel? Is it distinct? Kylie's a great answer to that. It's pretty obvious. And really important over the last 5 years or so, does it capture a new route to market that we don't cover yet? Again, Kylie was the first big success story of a brand that was sold over Instagram, completely new. And so really exciting for those two reasons. Every time a brand comes along, though, I would always ask the question, is this brand replicable? Is the business replicable? And what I mean by that, and one of my greatest triumphs, we were doing a deal in Brazil, and the CEO absolutely loved the brand because he loved the founder. And it's really hard to convince the CEO not to do something once they want to. This was a brand that really didn't have any replicability. It was not very distinct in how they did the business. The IP wasn't really well protected, et cetera. And so I was able to argue this is kind of a pop. And sure enough, the company that bought that brand, it floundered after the next couple of years. Emmett, we can go to the next slide. So there are actually some concrete ways, and this is some of the magic, but not all of the magic, of how I would sit down and make that determination after I got kind of a headline price to be agreed or to back up. The first is IP can oftentimes be very clearly valued. Actuarial accountants do this all the time. You'll see in public filings of companies that they wrote down, for instance, Cody wrote down the value of CoverGirl. So they can do an actuarial analysis of brand value, which can lead to your overall M&A valuation. IP assets are often really easy to value. So licenses, if you have 7 years left in the license and the license royalties that come out are $5 million a year, you start at 35 million, then you ask, how easy is it for that license to be renewed or not? And you figure out a value from there. Distribution agreements the same ways. So a lot of times in these highly licensed trademark businesses, there's really concrete elements that back up an overall value. And then I think the most important, when you're sitting in the seat of a seller, is to think, what could a buyer want out of your brand? In other words, do your homework. Synergies, I think everyone knows what they are. Are there IP elements that that brand is looking for? We looked at one brand to buy, not necessarily because of the product, because they had technology in digital atomizers, which we thought could have been really interesting for gifting, for brands like Tiffany and Gucci to sell over the holiday season. We didn't buy it because the IP wasn't that novel. EPS dilution is huge. You don't want to buy a brand that ends up hurting your bottom line if it's on the upward curve. So you'll see often brands want to buy less than 50% or more than 50% if it's doing well. You might have seen that Richemont divested Yoox Net-a-Porter to below 50%. I assume from an accounting perspective, it will no longer be in its profits or losses over the year. And of course, the circumstances of the buyer and the seller. I represented Cody when we sold the hair business to KKR. It was a great time for KKR, not the best time for Cody. So from a strategic perspective, for KKR to come along, it was the right time. And in that deal, there was a real benefit there of the business that KKR could make, revolutionizing the hair business with e-commerce. So e-commerce was really the delta in the valuation there. Emmett, next and last slide. So this is the part of me that comes more like a lawyer as my training, but I think it's absolutely key when you're thinking about evaluation. One of the biggest nightmares that I ever had in a deal was when AIG, the insurance group, was getting broken apart after it failed. And the head of M&A at the time sold the deal to all the buyers as, imagine an absolutely perfect deal. Give us a price based on a perfect deal, and then we'll do purchase price valuations. It ended up being the worst, most protracted contract negotiation and one of the longest post-closing processes in the history of insurance M&A. And that's largely the product. So you need to think about where these liabilities fall into your valuation and how you want to play that. As you do diligence, there'll be what you know as direct liabilities, i.e. things that are right from the headline are going to be an issue. There's no question they're going to arise, or contingent liabilities that may or may not arise based on a percentage. The direct liabilities, they pretty much will come off the top of the purchase price. Contingent liabilities will always be a fight, often be with holdbacks. Headline price adjustments I talked about a bit. There's a question of, do you define them as purchase price adjustments, indemnities? Earnouts are really large when you're talking about, as I said, these founders that need to be incentivized to stay along with the deal. And finally, interesting to think when you're doing a carve out, which perhaps might not be the case here, but always good to think of, are there transition services? Are there interdependencies? Are there people that need to stay along to hold up the business and allow it to grow in the short and medium term? Because those will be actually sliced off the price. So overall, I used to sit there and say, what do we need to make this deal whole, to make it be exactly what they're selling and what we're buying and why we're buying it? So I hope that's helpful, and please let me know if you have any questions.
Great, thank you, TJ. Again, please submit questions for TJ via the Q&A button. Great to hear the view of a corporate and more of a private equity view than just an aggregator view. Good for comparison. Okay, so let's move to the two FBA aggregators. I'd like to invite Sean to the floor. Are you there, Sean?
I'm here. Can you guys hear me okay?
We can. Over to you.
Perfect. Awesome. Well, thanks, Emmett. I'm Sean Lee. I'm co-founder and president of a company called Cincy Brands, and we're slightly different than an Amazon FBA aggregator. I would say my co-founder and I's background, we spent about 25 years at Procter & Gamble and strategically set up the company in Cincinnati, Ohio, kind of in the backyard of P&G and then Kroger, one of the largest retailers in the US, to kind of build a CPG aggregator holding company. I would say we're probably more like a smaller version of Win in what we go after, where we're looking for things with a little bit more diversified revenue streams. So Amazon will likely be a large priority of that, but we're also looking for some revenue coming from Shopify or revenue coming from niche brick and mortar retail. And our thesis is we can acquire brands kind of in the 1 to 10 million range that are growing and profitable and take them to the next level through strategic investments in the marketplaces, their D2C channels, and then by taking them to the right brick and mortar retailers. And our belief in that is, at least in the US, brick and mortar still makes up 79% of all retail. So we believe if there's a fit with a retailer and you can launch there, it can really help maximize the overall value of the brand and diversify if you do it smartly and do it well. Next slide, please. So some of the valuation trends that we're seeing in the space, I would say really in the past quarter, 2 to 5 times SDE. On the low side of things, it's very much if you're an Amazon only brand, if you're a product versus a brand. So maybe you have, a trademark, an interesting product that you're private labeling, but not really a brand with a point of differentiation or a reason that you can command a price premium or have people keep coming back. The other thing is lack of revenue diversification. So that could be 100% Amazon. It could be a Shopify site where you're over reliant on Facebook. We really like to kind of see revenue diversification to get a higher multiple. And then dependent on one SKU as your hero or way too many SKUs. So oftentimes you'll see a brand where, they may be doing a few million, but 90% of it is from one hero SKU. And then everything else is kind of the long tail, or there are way too many SKUs and the brand is incredibly complicated to operate. The other thing we see is if you're flat or declining gross revenue, you're probably going to trade at that, 1 to 10 times SDE or a very low or negative EBITDA range. We'll consider something with kind of flat or negative EBITDA as long as there's a clear path that we believe our operating company could put some operational fixes in place to kind of immediately make it profitable. But that's very much a case-by-case basis. So as you're looking to maximize your value, I think building a brand with a point of differentiation, I think all the examples from the Win brands are great examples of something that's built differentiation and kind of built, a brand and a following behind each of them. Revenue diversification, so that could be Amazon, Walmart.com, Shopify. Maybe you have some wholesale or retail accounts. And product diversification, you're not relying on kind of a one-trick pony, and that you get your revenue from a variety of different SKUs or products. The other thing is not overly complicated. Is it an efficient thing that you can run with an easy supply chain and operations? Are gross product margins good? And then consistent revenue growth really for the past 2 or 3 years and looking at the last 12 months. And then EBITDA percentage between 15 and 20 plus is really what's going to help you maximize your overall multiple. So if you go to the next slide. And I'll just run through a quick example of kind of a low valuation example that we had recently looked at and actually passed on. It was a pet supplements business with about a 5-year selling history. They had 5 products, with one of them really being their hero product, probably doing 60-70% of the overall revenue. Their annual revenue was about, I should say 750,000, not 750 million. And their SDE was about 100,000. The problem with this brand over their trailing 12 months is they were going in and out of stock with their hero products. They were having supply chain issues. It wasn't very reliable. Their ad spend was kind of going up and down with that. And then the buyer or the seller didn't really flex their operating expenses during that time. So in some months you'd see wild swings in profitability as product was coming in and out of stock. So for them, it was very hard to value that business or really set them up for a really good sale. The opportunity for the person that ended up buying it, we chose to pass, was if you looked at their past 3 months, they were in stock. They had commitments from their supplier that the issues were resolved. And reasonably, by staying in stock, they probably should have doubled what their gross revenue was and really improve their kind of overall SDE or EBITDA. So for that, the valuation, that owner sold really for about 2 times their kind of current trailing 12 months SDE. It was a great value play for the buyer that ultimately bought it, but not a great value for the seller because they had all of these issues. My advice to a seller would be, if you know that you can kind of get through some of these supply issues, fix them and really get, 1.5, 2 years of solid growth rate to show that all of that's been worked out to set yourself up for maximum value in the future. Next slide, please. And then a higher valuation example would be in the beauty care niche. There was a brand that had about 12 products with solid revenue diversification, about $5 million in annual gross revenue. The other thing we liked about it is their gross product profit margin was around 89%, and their SDE was about 1.3 million or 26%. So this business sold for about 5.8 million, or about 4.5 times SDE very recently. It had a strong EBITDA percentage. It was growing year over year. Last 12 months, it had kind of flattened a bit, but was still growing in the 5 to 10% range. And it had great diversification across products and channels. So of their 12 products, very diversified revenue, and then also had a good balance of their business coming from Amazon, Shopify, and about 20% from some niche wholesale brick and mortar retail that they had built up. And it had a great supply chain and kind of operational execution. Next slide, please. So I'll leave you with 3 tips to maximize value that are probably similar to the themes that you've heard here. One is focus on profitable growth. Don't focus on top line over everything else. I think if you focus on your kind of EBITDA growth and margin expansion, that's really going to help you when you're trying to maximize value, when you're setting yourself up for a sale or having somebody value your business. The second is focus on the fundamentals. So make sure your fundamentals are sound, and from your supply chain to your operations, to your ad spend, to your marketing, because a well-run business is very valuable, and really can show consistency and set yourself up for a great valuation. And then, as others have alluded to, have a future forecast. So provide a realistic future growth forecast that the buyer can execute. And that could be, launch these new products or enter X channel or expand to Y country, but make sure it's realistic and not kind of cookie cutter. And then be prepared to answer the question, well, if you have this great forecast, why don't you just execute it yourself? And that could be cash flow constraints. The business needs more capital to expand into, X retailer or into X country. But make sure you have a realistic future forecast that is achievable and can provide a roadmap to the future buyer. Great. With that, I'll turn it over. Thanks, everybody.
Great. Thank you, Sean, and appreciate the 2 case studies. That helps communicate simple examples about valuation, which is really helpful. Excellent. So let's move back across the Atlantic to Tommy at Olsam Group in London. Over to you, Tommy.
Hi there. Can you guys all hear me? So I'm the investments director here at Olsam. So Olsam is an acquirer for brands focused on marketplaces. It doesn't have to be on Amazon, but it can be across marketplaces. But right now we are focused on Amazon. Slide, please, Emmett. So this slide, I think, says 1,000 words. You can see the trend of multiples over the last couple of years. Over the last year or so, let's say in 2021, multiples were high, let's say. It was a pretty boom market for sellers. Now, moving through 2022, conditions, quite frankly, have become a lot more challenging. Central banks are tapering. We have increasingly high inflation rates. Now, interest rates are getting to, well, for the first decades or so, we've seen the first rate hikes across the world, basically. And that means that funding has become an issue on both the sellers as well as the Olsam side. So by that, I mean the rising interest rates means that the higher cost of capital, meaning that the free cash flow that the brands that we acquire has to cover the rates that we also have to pay. Now, as we move into more of a consumer-led, let's say, headwinds on revenues, that means that the valuations that we pay on the upfront have become depressed. Now, that we can see that in Q3 2022, multiples have come to around 2020 levels. Now, if you go to the next slide, Emmett. But that doesn't mean that the valuation that sellers get is going to be depressed in the long term. What that really means is that you might take a lower cash up front that you may have got in 2021, but that also means that there's a lot more opportunity for you to receive the full valuation that these sellers deserve across a longer time horizon. What that really means is that you should embrace the future payments. So what that really mean is are there earnouts? Are there deferred? Are there contingent payments? Are there any various ways of paying the seller for the value down the road? And that means maximizing the value across a long-term, across let's say 4 or 5 years rather than today. That means that rather than getting a 2 to 3.5 times upfront, you could be really achieving 4.5, 7.5 times across the lifetime of the brand. Next slide, Emmett. So where does that fit within an acquirer's, let's say, mandate? So I'm sure all of our panelists here, so Sean, Kenneth, Thomas, Eric, you will have different criteria. But that really boils down to what the right acquirer means. So for us, we are very category focused across the left-hand side, which is home, baby, pet, sports, and personal care. Now we move into an environment where to maximize valuation, the brand has to be very focused. And we've built a platform here where we can plug and play brands across our entire portfolio relatively easily, as long as the supply chain, as long as the operations are, as long as the number of complexity that the brand brings is relatively under control. And we've built a category focus across these 5 verticals. Now, for the products and brands that maximize value for us and acquire for the brands that we acquire, that really means brand equity. Now, what does that mean in practice? Is there a brand identity? So is a portfolio of products that the brand has, are they coherent? Are they all within one vertical, or are they a collection of hodgepodge of products across a whole wide array of categories? Does a brand have IP? Does it have protection? Does it have patents? Does it have some kind of defensibility? What that means is that can we enforce that across the marketplace, meaning that we become the go-to brand for, let's say, buckets, or for outdoor equipment, for tableware, for pet supplies. That just means that we have a lot more defensibility for the brand so that we can, at the end of the day, create brand equity. Now, the second and third verticals are relatively similar to some of our other acquirers out there, but what's the consumer perception of the brand? What are Amazon fundamentals? Where does the product rank? And what are the growth levers out there? So can we launch the product into new markets? Can we launch it into new channels? Can we launch it into new product launch? New products or new product variations. And what this means, that referring to the previous slide, is that you have the cash up front that you receive today, and the earnouts and the deferred payments that you get tomorrow. Now, when we pull all of these growth levers that we have built, we have employed professionals to do that, you as a seller, or the brands who end up selling to us, get to benefit from all of the levers that we end up pulling. So next slide, Emmett. So just to give you a quick example of one of the brands that we acquired, which is called Pour 5. So this is the original snuffle mat. So they sell grazing mats for dogs, which slows down the eating habits of dogs. Now, the brand, when we acquired it, was a bit unloved, but it had a lot of patents. So it had a design patent along basically the design of the mat, as well as utility patents, which are the design of the noodles, as they say, and the functionality of the mat, which means that we have defensibility both on Amazon as well as a wider retail space. And of course, they have trademarks as well. So for this brand, this fits all of our criteria, which I referenced on the previous slide. And therefore, we value this much higher than we would value a brand which doesn't otherwise have that. Now, our criteria might be different to some of our other partners and competitors out there, but that's why I encourage for sellers is that to maximize your value, you have to find the right partner to maximize overall deal value across the long term and not just today. I think that's it in terms of my slides, Emmett.
Great. Thank you very much, Tommy. Appreciate that. Excellent. So thank you to the 5 speakers. I will now give you the thoughts from the Fortia group, split into 3 sections. The first is some data points on the macro context. The second is valuation ranges for both FBA and DTC. And the third is some of the best advice we've seen from sellers on prior webinars. So regarding the macro context, there's some interesting data points that came from S&P and also Carta last month. So look, it's no surprise, right? But global M&A activity is down significantly for a lot of the reasons mentioned earlier on, such as increasing interest rates and so forth. So that obviously affects valuations, just given the basic supply-demand factors. If we drill down a bit further, consumer discretionary on the right-hand side and consumer staples fourth from the right, they're the 2 areas where e-commerce brands operate. So the number of exits, and these will clearly be more bigger exits on Wall Street as opposed to maybe smaller brands. But with the weakness of the consumer and the recession that's looming, deal activity in the sectors we all care about, in consumer sectors, has been low. If we drill down then into some fascinating data from Carta, the equity funding into consumer companies has been dropping significantly. Probably started when iOS changes happened in last summer a year ago. And obviously with the performance of e-commerce in the last 1 to 2 quarters, that hasn't helped either. So the equity investment into consumer brands is quite low, and that means some companies aren't able to get additional funding rounds, or they mightn't be able to get new funding rounds, seed, Series A. So some firms are being forced to look at an exit sooner. So there's a lot of firms coming to market, and some in distressed situations. There's also a trend towards larger deals, both at the Wall Street level of the world, but also this is Carta data, so it's for smaller deals, and I think this trend has been seen in the aggregation space as well, which we'll touch on in a moment. Buyers are seeking to do fewer, bigger deals. There are some exceptions to that, but I think that's a broad-based rule that most people would agree to. So I just thought they were helpful data points to sort of set the scene. So we always get asked, what are the valuations? What are the ranges for maybe an FBA business and a DTC business? So we have put our thoughts down on paper. So let's start with Amazon FBA brands. The STE multiple we have from before, which is sort of pre-correction, and today. I just want to highlight some notes before I jump in to give you some comments. So the source for these ranges isn't just from the Fortia group. It's from a number of sellers and several acquirers that we've spoken to over the last few days. So it's not just my view or our team's view. We've sought to really represent the entire market here today. And our forecast today, 2 to 5x, matches what Cincy, what Sean said earlier on. The multiples here do not include any equity incentives. They do include any form of deferred consideration. So that could be a stability payment or an earnout, are included in these numbers. But it's very difficult to include equity incentives. By that, I mean an aggregator, for example, could give some share options in its actual company to the seller. It's very hard for us to track that data at scale. STE, for anyone that doesn't know the definition, is seller discretionary earnings. Typically, it's net profit plus add backs. And these multiples only apply to Amazon. Clearly, there's lots of other marketplaces out there where, for example, Pontia would play in Eastern Europe and so forth, where Dwarfs would play, and BOL in the Netherlands. They're likely to have lower valuations given there's just frankly less buyers. So I want to give you our comments on these ranges. So there's a bit of detail here, but it's hard to sort of surmise valuation in a few points. First of all, if we look back, valuations peaked in summer last year, and they stayed high until probably February, March this year, when we started to notice a drop. particularly when we I went to the Prosper show in Las Vegas. So there was rumors of difficulties coming there. Since March, a lot of the buyers will just say that average isn't good enough anymore. It was relatively easy to sell an average brand last year. It's absolutely not today. Buyers are being very selective. Therefore, again, supply demand factors impact multiples. Clearly, there's increased costs and headwinds, as we've seen from last summer, when there was clearly supply chain issues last year, increasing PPC costs, rising costs from Amazon. All of these make it tougher for e-commerce entrepreneurs to continue to increase revenue and margins. And from a buyer perspective, it makes SDE growth risky. And if there's risk involved, they'll take a haircut to valuation. At the start of 2021, aggregators were open to deals where the companies had revenue from $1 million. That was a rule of thumb at the time. That has increased to 3, if not 5 million now. So aggregators are looking to do fewer, bigger deals. There are some exceptions to that. Sorfeo is an aggregator, for example, that does smaller deals, but mainly the big institutional buyers of brands are looking to do bigger deals. That leaves smaller brands in a difficult situation. There's not as many institutional buyers anymore. In our June survey 2 months ago, we had 35 aggregators indicate that 47% of the deals they were doing were priced between 3 to 4x. So whilst we say that the range is 2 to 5, I think most of the deals are getting done between 3 and 4x. A year ago, just under a year ago, deferred consideration was 25%. So 75% upfront was common. And that's from a survey we did of aggregators. But that's changed significantly in probably the last 3 to 6 months, and will continue to do so. So buyers are looking to offset risk and have a bigger component of consideration that is deferred. Probably no surprise, but we're seeing it through data points. We've touched on this slightly before. Aggregators are increasingly offering equity as a form of incentivization. I think that was probably novel in that last year. Some aggregators were doing it, but we're seeing it more and more. So again, it's a way for aggregators to offset risk and get the sellers bought into the future growth of a brand. These ranges here, clearly some deals have been priced below these ranges and above these ranges. We wanted to just put forward our best thoughts, and not just our thoughts, the market's thoughts on actual ranges. Clearly, if something's incredibly distressed, it could be priced much lower. And of course, if it's a diamond, it could be priced much higher. Tommy from Olsam has just referenced a deal getting eight times, and that's 8 times up front. That's sort of the very peak of what's happened in the space. And so deals have priced above and below these ranges. So let's be positive. What do entrepreneurs have to do to price above even 5x? So they need to be diamonds, which is tough, right? What are the key characteristics of diamonds? It needs to be a very strong brand. We've heard that from a number of speakers. It's no coincidence a lot of aggregators have the word brands in their names. They're looking for brands, not products. There needs to be large revenue, 5 million, 10 million plus. The larger it is, potentially the higher multiple it is. It needs to be revenue growth, can't be revenue in decline or stable in order to get the punchy multiples. Has to be 20% net margins and significant growth potential. Has to be lots of room for growth. And a good example of this, in our view, yesterday when we went live with a really exciting brand, a beauty brand doing 48% net margins, which is incredible, growing, 5.3 million top line, fast revenue growth. And it's going to attract lots of interest from aggregators, but also private equity and strategics who traditionally have paid higher multiples. We'll come back to this during the discussion. I'm sure there'll be lots of questions and thoughts by my fellow speakers. So let's switch to DTC e-commerce brands, for example, Shopify brands. So the range here was 5 to 12x before, and today is 2 to 9. It is incredibly wide. It's hard to have a narrow range given there's just so many things going on, from brands suffering from iOS changes to ones that have recurring revenue, ones that don't, ones that are larger, ones that are smaller. But so apologies for the width of the range, but it's the best summary that we could do, and we'll give more granularity on how to get higher multiples in a moment. Again, the source of these ranges isn't just from Fortia Group, it's from sellers, acquirers, and other people I deem to have relevant expertise in the space. The definition, again, this includes deferred consideration. It does not include equity incentives, which of course are increasingly being used. And EBITDA instead of SDE is what's used when we look at Shopify type brands, which stands for earnings before interest, tax, depreciation, and amortization. So the Fortia Group's comments, if we look back to before, sort of Q1 or before multiples, the range we give is 5 to 12x. To get higher up that range was typically for bigger businesses. So for example, we know of a London-based aggregator that acquired a 4 million EBITDA beauty business in the UK for 10x in November last year. So there was a lot of deals happening at sort of the 10x type level, particularly for bigger brands. Clearly some deals are priced below that range before, and also the current range. There's an aggregator called the Hedgehog Company, which specializes in acquiring distressed brands, and it is acquiring at very low multiples. For full disclosure, the Fortia Group is a shareholder of the Hedgehog Company. And to any buyer who's listening on today's call, if you are interested in distressed brands, please do reach out, because I can help you via our partnership with Clearco. They have access to incredible amounts of data and can identify which brands are in distress. Since the iOS changes last year, VCs have been investing less in consumer brands. The data from Carta showed that, provided evidence of that. But also recent performance, revenue performance doesn't help. VCs want to get into the space. So look, that means there's a flood of companies coming to market that can't get VC, which in turn impacts valuation. Again, the supply-demand factors. I think it's also fair to point out that working capital financing is also becoming more challenging. Again, that has an impact on the financing ability of companies and whether they have to ultimately exit instead of get capital. Again, sorry to harbor on about this one, but buyers both on FBA and DTC are offering equity as a form of incentivization. So again, let's be positive. How do brands get towards the upper end of the 2 to 9x range, or indeed above it? They need to be diamonds. The key characteristics, again, got to have a strong brand, ideally have large revenue growth. Big difference here, DTC, successful DTC companies, because they own the customer, have a bigger chance of recurring revenue. That's massive from a valuation perspective. So critical for DTC entrepreneurs to focus on. Net margins of over 15%, great team. Obviously, DTC businesses typically have more employees. It's really critical that they've got a great team, especially for larger firms that the buyer wants to keep and take on and help drive growth forward. And there needs to be significant growth potential. So to bring all that together, these are the valuation ranges that we're putting forward as of today. Clearly, it's very fluid and will change. And this slide will be discussed first when we get to the panel session in a moment. I'm sure there's lots of questions, and I will ask my panelists colleagues for their input to make sure that you're getting not just the Fortia Group's view, but everyone's view on the call. Okay, I think it's helpful then for sellers on the call to hear advice from their fellow sellers, from people who've actually sold their businesses. We did lots of interviews with sellers back in Q1 this year, and I just picked 3 of the slides from that session. This is a brand called ATV Global, sold for approximately $100 million. And we asked Ashley what he would do differently if he was to sell again. How do you increase valuation? So number 1, hyper focus on margin. Number 2, unique IP and differentiated products, and number 3, build a brand with a capital B. So we've heard some of those points echoed by other speakers today, which is good that there's overlap. The second is Gaji, which sold to Dwarfs in Amsterdam. Ludov talked about a more detailed growth plan, show the buyer where the growth will come from, focus on margins. And this was in Q1, but net margins are key at the moment, given the obvious difficult environment we're in. And think about an exit earlier. That's certainly one of our key pieces of advice. Plan early, Finally, TCA brand, which sold to Seller X, focus on margin. Again, lots of overlap here, lots of similar advice. Increase brand value and maximize sales by limiting out of stock. So hopefully that's helpful. Frank, thoughtful advice from sellers who've got big paydays. Okay, so that's the view from the six of us. We'll now move to a discussion with you all. We have 5 panelists. I'll share the questions from the Q&A. But first of all, what I'd like to do is just jump into what I think is one of the key slides in the deck, trying to bring together all the thoughts into one slide about valuation. If I can ask the panelists to please turn on their camera and their audio, and if I wanted to, if anyone wants to give comments on this slide, please do so. Eric, Ken, TJ, Sean, what are your thoughts on this one?
This is Ken. I can speak from the direct consumer side. That's where we kind of exclusively deal in. Actually sent you an email earlier, Emmett. What we're seeing in the 2 to 9, we're actually sort of seeing mostly like in the 5 to 6x range for most of the deals right now, where before it was probably overinflated, to be honest with you, in my opinion. But yeah, that's when those big multiples were.
And Ken, what 6 months ago, what was the 5 to 6? Was it?
It was 6 months ago, maybe I would even say probably closer to a year ago, is when we were seeing like the 8+ range.
Okay.
And in my opinion, I think it was a little bit due to the tide, and it was a little inflated at that time.
Okay. Eric, any thoughts from your side, please?
Yeah, I was actually gonna respond to, I think there was a question about what about omnichannel businesses, and I would actually argue omnichannel follows the D2C multiples here. I mean, when I mentioned the businesses we look at, there's 60+% Shopify. The rest could be wholesale or some variant of wholesale and marketplaces, and we still look at these ranges. The 2 comments I would add to this that have caused some confusion in the market, it's actually more tied to the Amazon side, but I've seen it spill into the D2C side. And that is this multiple, from my perspective, this is the enterprise value, right? So this includes the assets, the inventory, et cetera. But every now and then I talk to a seller who wants the inventory to be valued separately, that you should be purchasing it outside of this multiple. And unfortunately, I think this was a byproduct of some of the Amazon FBA guys in the early days getting around their leverage covenants and trying to get very kind of cute and creative on how much they were paying for a business. And I mentioned this to all the sellers out there just to be thinking about this, that inventory is not a separate number in my mind. It is part of the underlying assets to create this. So you should look at this as inclusive to all parts of the business versus looking separate. I know those deals still happen, but I think it's an interesting thing to be thinking about. And the other piece I would say is what isn't reflected here, and I kind of touched on it a little bit at the end of one of my points in my slides, which is structure. And I really want sellers to think about this because you can get a 3x deal that can be absolutely fantastic in terms of the upside, how you're going to get paid, et cetera, versus taking a 9x deal where half of it is in the equity that Emmett talked about that you'll never realize, right? Or half of it is in an earnout you can't achieve. And so I do think it's really important to think about structure as to a piece of valuation. In fact, I always tell people it's the most important thing to think about versus just targeting a specific number.
Yep. So in the beauty and fashion industry, why this was so important, why the valuation is so different, is because brand control, frankly. Amazon, as I said, we treated it like another wholesale customer, albeit an important one, but it was just the same as Walmart, who would sell things in store and sell things online. And with some exceptions for selective distribution, once you put a product on a platform like Amazon, you have no control over how it's sold, where it's sold, et cetera. And so DTC was really a way to keep brand control. less important in beauty because of how people buy lipsticks, mascaras, etc., but imperative in fashion. Like if you didn't have a DTC pillar in fashion, there was no way we'd look at your brand.
Mm. Very good. Thanks, TJ. Sean?
Yeah, no, I think I would build on all that. I mean, even on the D2C Shopify side, I'd say we're probably seeing in that, 4.5 to 6 range. And same for omnichannel. If a brand has a decent split between Amazon, Shopify, and maybe they're in one retailer or they do 30% of their volume through wholesale. So it really depends. And I would echo the structure point. I think a lot of deals that I'm seeing, and I think people that, for founders that are kind of new to this and maybe haven't talked to somebody like yourself, Emmett, or really done their homework, they maybe see the valuations from a year ago and think, 6-7 times upfront in cash, which isn't really happening anymore. So it's really important for founders of brands to really think through the structure. Do they want more cash up front now, or do they want things in part of equity or in an earnout? And I think in reality, cash up front can probably be a very good thing and something that you can control versus tying it to, an earnout or equity that, may or may not be achieved or may be achieved many years down the road.
Yeah. A few questions. What do we mean by before? We mean before the correction, so think of it that as Q1 2022. What surprised me is there's a lot of advisors in the market saying that their valuations have not declined. And I just find that absolutely crazy, having done corporate finance for 2 decades. Just take a look at valuations of listed companies. If anyone wants an independent guidance, and e-commerce companies, valuations are down. It affects all of us. Even aggregators valuations are down. So how a brand valuation is not down is beyond me. Question asked earlier on is, if a brand isn't profitable, is that of consideration to your business, or where should they look to? Obviously, I've mentioned the Hedgehog Group earlier on. Any thoughts from the panelists on that question, please?
I can jump in. So this is Sean from Cincy Brands. We'll take a look at it. I think it really depends on the business and the fundamentals and how it kind of got to the point that it is. If there's kind of a clear path, or maybe the business had too much funding from friends and family or personal capital, or maybe took some debt early on, and the operation or OpEx just doesn't make sense. Like I've looked at a beauty brand that in reality, if they solved some cash flow problems, stopped air shipping from China, and then didn't have 6 US based employees where you could outsource some of that to offshore, like that business would swing to be very profitable very quickly. So I'd say every brand and every story is different. We're happy to take a look at it because we can find some values there, may be able to give founders an option for an exit based on that. But it really is very dependent, and there's no one size fits all answer.
What do people think about timing? If you're a seller today, do you think valuations have stabilized or bottomed out? If you were honestly looking to sell, would you sell now, or would you wait till Q1 next year? What are the thoughts of panelists?
Well, I would say, if you have a buyer interested, seize the moment and push it forward. I would say it's very hard to predict like when to wait. My earlier advice is, if you're really struggling on the growth side, but you can focus on the profits, you do need to hunker down, right, and operate that business through this storm. I mean, we always say at Win, we're kind of like a really safe port in the storm. And the reason, like for us, we're open for business. We're buying companies, but we have a lot of conviction of, okay, here's the 5 points of things that we need to work on and work to improve. But I wouldn't, again, you have to make a decision. Is if you got someone's interest, you should explore it, versus trying to time it. It's hard to predict the future as to where things we can go. The headwinds are certainly there in terms of supply chain, inflation, et cetera. So the question is, do you have a balance sheet that can weather storm? Having gone through 2 of these cycles myself, what I always say to people, I'm like, look, this is where you close the doors, you shore up, in terms of your balance sheet, and you ride it out, because there's very little things you can do to actually drive like massive growth absent of you catching some lightning in the bottle, which is very hard to do, and usually a sign that you've got something a hack that you're doing that's not sustainable over long term. So you really want to figure out how you can kind of manage through it. One point I wanted to add, Emmett, if it's okay, because it falls into some of your data points earlier, which is valuations coming down. And this might be another interesting data point to share with the group, but where public comps are trading. And the reason I bring that up is people ask, they get focused on this valuation number, but there's two constraints you have to kind of recognize. So I'm going to let everyone inside baseball here on what's happening on the other side, the buyers, right? If you're a public company, you're not paying a higher multiple than you are trading at yourself, right? So you can literally look at a public company and say, hey, why are they not paying me 10 times? Well, they're trading at 4 right now because of the market, because that's a dilutive acquisition for them, right? And so it's a very clear math that they're going to look at. So you can see really what they're labeled to flex at, and public comps have come down quite substantially. The other piece on the private side, and this is very true of the Amazon aggregators, and when we have financing, but we're buying businesses with debt, right? And the reason this is important for the sellers to understand is we have constraints. As much as I want to pay you 10, 20 times for your business, as much as you feel passionate about it, I actually can't do it. And no buyer is going to tell you that, but the dirty little secret is they can't. They can't do it because their leverage multiples right now, if you are feeling pain, imagine the aggregators are feeling pain. We all want to say we're the best operators in the world, but we're not immune to any different problems that you're having, which means if our EBITDA is coming down right now, our leverage is going up, which means we have a challenge paying more for a business because it's going to negatively impact our covenants, right? And so there actually are capital constraints going on that you want to recognize. So it's not a buyer being a difficult finance person saying, I'm going to get this for 3 times. They actually literally can't afford to pay you 4 times, right? That's a real thing that happens. If they can stretch, the reality is they might be using their equity dollars. And I would say, great, but recognize that means they could be going a little undisciplined in terms of their buying. So these leverage covenants actually enforce discipline on the buyers. And it's not a bad thing, but it's a real constraint you want to be acutely aware of, because getting back to Emmett's original point, if you wait, these covenants could get tighter for all these businesses in the next few months, and their ability to pay is going to come down even more, which is why if you get someone, if you're hooked on, like, seize the moment if you can do it.
Yeah, that's helpful comments. Thank you. Ken, TJ?
Yeah, happy to just add to that, Eric, that those are all good. And I would just say from timing standpoint, I kind of look at it as, I think there are benefits to any kind of climate that we're in. It just, you have to look at it and kind of orient your business around it. So I almost would say is it a right time for your business? Like, whoever, if you're looking to sell. So like for our businesses, we're like, okay, well, are we really profitable? Do we feel like we're going into profitability or going down? Like, is the timing good for us? And I do think it's a little bit different for every brand and every business, because, for some brands that, in some ways, when revenues are going sky high, like advertising costs are also sky high. And also when we're walking into a recessionary period, advertising costs go down, and so there are opportunities on both sides. So what we look at is, right now we're looking at how do we focus heavily on profit. And I think for the last many years, like especially in the e-com space, we see a lot of people focusing only on revenue. It's a very tempting thing to focus on, right? And kind of leaving profit to the side. So if I were giving advice to any brand looking to sell, I would say, how do you build a really healthy company? Like, how do you create a really profitable company right now? Forget about revenue. Don't be, Casper Mattress and all those types of brands that are revenue at all cost. And then I think it's a great time to sell. If you can show increasing profit into recessionary period, I think you're actually really strong from a balance sheet. So
you can become a diamond, which are becoming rarer. TJ, any thoughts?
Yeah, I think Kenneth hit the nail on the head, which depends on the product. And we've always found in times of economic downturn, lipstick sells well and alcohol sells well. There's been a weird skew in the recent past about how prestige beauty has been behaving. But I will say we've seen a lot of PE firms focusing on luxury fashion, not as much very recently, but a lot of beauty companies focusing on prestige. And they're bound to find in a year or two that they have a big gap in the consumer space, in the things that are sold in Boots, etc. which is why things sold in Boots did so well during the downturn, because people could shop there, CVS, Walgreens, etc. And so I think it's right. As long as there's a good product at a good value for buyers, cash on hand, which there are some, that will be the right time.
Very good. Are there any points about valuation that we haven't covered today, panelists, that you'd like that we should cover?
I saw a question in the chat that may be good to discuss. Is I know a lot of us have talked about brand being a big part of the value, and someone asked, what is the difference between being a brand and being a product company? So I don't know if that's worth discussing. I can give
look,
seconds on mine. Yeah,
please go ahead, Ken. Thank you.
Well, at least from my perspective, and then I'll let everyone else talk. But like from my perspective, being a brand is a solution-based company. It's a story. It's actually, if you have a brand, it's like kind of your greatest moat, because it's hard to rip off a brand. It's a lot easier to rip off a product. And so to me, the difference is, when you have loyalty from a customer because you have quality and trust, and that takes time building, versus a product only company, to me anyway, would be, for instance, on marketplaces like Amazon, I think it's a lot easier to fall into being a product only company, because we all know that feeling of looking around for a solution on Amazon. We buy a product, we don't know who we bought it from, and we're just trying to solve a problem. And to me, that can be done. That could be the case on direct consumer, like e-com only or Amazon, but that's a product only company where the consumer, there's no stickiness and there's no loyalty.
Yeah. Understood. I mean, totally buy into that. Products are at the risk of significant competition from the Chinese, and it's a race to the bottom from a margin perspective. And as an investor or an acquirer, that's the wrong place to be hunting. But I guess it's easier said than done. I'm not an operator, but it seems to be easier said than done to create amazing brands, right?
Absolutely.
I'm just a finance guy. What would I know? But it seems to be easier said than done.
It is.
What about what about, we've discussed timing. What about increasing deferred components to consideration? Eric's touched on that. Is that are you seeing that, Ken, Sean, others?
And would you repeat? You broke up just a second while you were asking that question.
Sure. Are you in the deals you're bidding on? Are you having more weight to deferred consideration, whether it's earnouts or stock?
Yeah, we actually, for us, always look at that, because part of our value is trying to, we look at deals that are typically founder led, and they've kind of gotten close to the top of their ability to scale the organization, but they still have passion for the company. And so that is usually a big portion of what we look at.
Yeah.
I think I'd do a deal without deferred compensation of some kind. And it would probably be broken into both an indemnity portion, guaranteeing some sort of past performance for the future, and actually long-term compensation, because of the fact that these founders are so integral to the brands, and without them at least sitting along, the brand doesn't have much weight. For what we've done in beauty and fashion.
Yeah, I would say likewise to Kenneth, we're often looking at founder-led brands. We may want to bring them on or have them be a part of the journey after we acquire it. So we're looking at some sort of deferred, whether it's an earnout or maybe we let them retain, 10% in kind of the new entity that houses that brand. But that's been a lot of how we've been going to market, and we can kind of fit the different pieces together to put a deal together that's advantageous for both of us. But we tend to like that, especially when the founder is very critical.
So I'll ask each of you to give a prediction, please, regarding valuation in a moment. But before I do that, I have to mention a comment that came in here. An individual asked, is it a sinking ship behind TJ? And Thomas, would you mind moving slightly to the left or right there, just to prove it's not a sinking ship? And that's not a metaphor for valuations. It's actually a stairs, right?
Well, no. So actually, this behind me, I'm from Rhode Island originally, and it is a photographer from my area. So it's one of the tall ships. But actually the code name for the Wella deal was waves. So there's a massive wave behind my right hand shoulder. So I think that's and there's a staircase there. So I think a wave and a staircase is a nice metaphor.
Excellent.
Paul is backing me up. He's one of my former colleagues.
Very good. Okay, so predictions on valuations, and then we'll finish. Please give 30 to 60 seconds each. Who'd like to go first?
I'm happy to jump in. I personally expect that, again, I think it's dependent on the type of business, but I think they will go down, or the appetite will go down in the near term. And I think if you're acquiring, I think that's a good time to acquire. I think if you're running a brand, that's a good time to show that you can go counter to the market and actually really increase your opportunity to have a higher multiple in the future. That's my opinion.
Interesting. Maybe the ship is sinking for the moment then. TJ, Eric, Sean, who'd like to go next, please?
Yeah, sure. I'll go. But sorry, go ahead.
Yeah, Sean. I would say I generally think I'd probably concur. I think it's probably flat to going down, and probably a lot of it's dependent on the conversation we had around debt and what the Fed does continuing to raise rates, because I think as the cost of debt and the cost of capital continues to rise, that'll make it a tighter environment, since most of us probably put these deals together with debt and equity, and that's going to change the equation and make it harder to pay higher multiples than that we may have been able to do a year or 2 years ago.
We in fundraising for PE funds in the last 6 to 9 months, the groundswell shift was actually the invasion of Ukraine, because of the thought of consumer performance and cost of living. And so in the consumer space, I think that was the big concern. So I do think it gets back to having a product that is needed every day at different price points. It might not be the moment for kind of discretionary spending, but I think there'll be room for a good product. And of course, there are people that are not as LP or debt dependent. And so it's looking for the right acquirer and pairing that with the right product at the right time.
Thank you, TJ. Eric, to finish.
Yeah, I mean, I don't want to say they're going down. I would say they're becoming more realistic. I think that's like a really important thing for a lot of these brand operators to look at it. Many of these brands grew up in the, let's call it the post 2014, 2015 run up. The ones that started in 1819, they were seeing, SaaS valuations on consumer companies. I got news for everyone. It's not a SaaS business. It just isn't. Product must be made. It must be shipped somewhere, must be stored somewhere, sent out. It's not an infinite amount of servers you can spin up. And this is me saying this coming from a tech background prior to doing Win. And so it's interesting to see where it's going. If you really think about it, it's going back into a place where it makes sense from a consumer landscape. Multiples are getting down to levels where the payback period for an investor, if they were to 100% finance something in debt, is within 3 years. And that's the right target framing for anyone to think about is, how do I get an earn back on my investment? I want to be paid back in 3 years. When you're paying 12 times for something, it's just not going to happen because the group businesses can't grow that fast, at least from a profitability standpoint. So it's a nice way of saying, yes, they're going down from the numbers that Emmett showed, but I think they're becoming more realistic, which also means, and this is important as you're thinking about selling your business, it's not going to change. It's not going to hockey stick back in the next year. It's going to be relatively flat. You'll see multiples go back and expand when you start hitting on the 3 things that I talked about. Size premium, so you're a $100 million plus business. Margin premium, you're operating at 15 to 20%. And you have the right growth rate, right? And so when those fundamentals come back into play, you can start seeing double-digit multiples. But it's just how you need to operate, which is why I think we heard this theme of, there are a number of speakers right now, which is focus on your operations, build great businesses. You will find buyers. That's really important. Build a great business. Don't just shoot for revenue. It never works.
Very good. Thank you, Eric. And unfortunately, Tommy had to leave the call earlier on for a personal reason. So he couldn't participate in the discussion. Okay, so to leave you. So thank you for your poll earlier on. We will ensure that the next webinar on the 22nd of September is one of those top topics that you chose. Otherwise, all I have to say is thank you to Clearco, our sponsor, and all the speakers for participating. Great content, great voiceovers. It's a difficult time, but you know, some hopefully realistic, frank, honest advice for all the sellers on the call today. Thank you, everybody. Have a great day. Bye-bye.